Four incredible companies just reported today. We've got Coca-Cola, we've got McDonald's, we've got 3M, we've got PayPal. Remember, I own 3M and PayPal. Doesn't mean you should own it. Do your own research. I'm here to teach a process. I'm here to teach a process that you can apply to any company you want to go look at. Let's take a look at PayPal. PayPal actually missed on earnings per share. They reported $1.08 versus $1.20 expected. Revenue was $7.7 billion versus $7.5 billion expected, so they beat there. The stock is at $68. At one point today, it hit over $70, so it was up. Guys, PayPal has been hit so hard in the last few years. Look at this. All-time high, July 26th of 2021, $3.10 a share. It has gone this way. And what has happened to the news of the company since? Crap. People consider PayPal dead. Guys, for everybody out there who considers PayPal dead, let's look at their earnings result here. For this dead company, Q1 2024 revenue increased 9% to $7.7 billion. I'm not saying this is next Microsoft. I'm not saying anything, but 12 or 13 years ago when I loved Microsoft and everybody told me Microsoft was dead, I said, how are they dead when revenue is going up? I don't understand that. Again, this is not to say PayPal is going to be the next Microsoft and skyrocket 10, 20x. Not at all. But it's about teaching the fact that the emotions of the market can really weigh on people. That is what's so important in our videos. And guys, this is our new Everything Money 24/7 channel. We do earnings results. We do news releases. We do all these things, 4 or 5 videos a week. If you want to get up-to-date news, please subscribe to the channel. I'm recording this video at 10:04 Eastern time. This will be live before 11 a.m. within the next 50 minutes. That's how quick we are to respond. Okay, 2004 remains a transition year and we're focused on execution. That sounds like generic corporate garbage. But EPS increased 18%. 18%, guys. That's incredible. Non-GAAP EPS increased 27%. So even though they missed on $1.20, their non-GAAP EPS was still up 27%, and the GAAP EPS was up 18%. So last time I checked, dead does not equal growth. I don't know. Maybe I'm wrong. Somebody I know who's a member of the Value Investing Club said that it's one of the top 10 stocks of value investors. Who knows if they're right or wrong? All I know is the long-term play. I've been buying it in the low 50s, and if it goes even further south, I will probably buy more as long as my thesis remains. Okay, a couple of other stats here. Total payment volume increased 14% to $404 billion. Payment transactions increased 11% to 6.5 billion. Payment transactions per active account increased 13% to 60. Now, active accounts did decrease again. This is my issue with PayPal. That's the dying part that I hear about and I go, well, maybe people are right. Now, could it be that there's less accounts doing more like we're seeing here? Absolutely. But active accounts did increase 0.4% on a sequential basis. Cash flow from operations of $1.9 billion and free cash flow of $1.8. On a 12-month basis, free cash flow from operations of $5.6 billion and free cash flow of $5 billion. Okay, so what does that mean? Well, when you have a company that generates $5 billion of free cash flow at $75 billion market cap, that's a 15-to-1. Okay, that's the market average over time. So I'm looking at PayPal, and I look at PayPal saying, what's the future of PayPal? You know, I look at these things thinking, seems pretty good. So let's just do it in the stock. Let's look at analyst estimates real quick. Analysts are expecting EPS to double over the next 4 years from $5.60 per share to $10.68. It's a little less than double, but some solid growth there. And for the dead company, they're expecting high single digit to low double digit revenue growth by analysts. Again, they're analysts, and there's only 3 in the future, but either way, looks pretty solid. Let's do our stock analyzer tool. Let's pull up the last time I did PayPal. Let's look it up here. Okay, I did 4%, 7%, and 10% revenue growth the next 10 years. I did margins of 12.5%, 15.5%, and 18.5% on net income. Free cash flow is always higher, so I did 16, 20, and 24. PE, I did 13, 16, and 19, and I went a little bit lower only because of the competition. I can understand somebody saying 15, 18, and 21. It's up to you. And that's really important. And 9% desired return. The market number does not include any margin of safety. All right, so low side, maybe it's a little high, but in the middle, 91 to 120, high side, 150 to 200. I don't know, seems pretty good to me. Stock number 2, Coca-Cola. Guys, I want everybody to realize the day I die is the day that Coke starts to die, because I drink 6 to 8 Coke Zeros per day. For those of you who think that's a lie, it's 100% absolute fact. 6 to 8 Coke Zeros a day. I love it. And how did I learn about Coke Zero? Chipotle. One day they were out of Diet Coke, and I was like, oh, let me try Coke Zero. And I tasted it, and the clouds opened up, the light came down, and the heavens. I really, truly believed in God at that point. I knew there was a God when I tasted Coke Zero. I just want everybody to understand that. So they reported 72 cents per share versus 70 cents expected, so they beat there. And they reported 11.3 billion in revenue versus 11 billion in revenue. They beat there, a double beat. So let's see how Coca-Cola is doing right now. The ticker is KO. Coca-Cola Company is currently up, basically even. 62.50. All right, this stock has done nothing for a long time. 10 years, only up 110%. Actually, it's not. No, it's done well. I'm sorry. I apologize. Not bad. All right. They have a dividend here of 3%. Eats up $8 billion of their cash flow. Now their cash flow is $9.75 billion last year, 9.5 for the 5-year average, and their dividends are $8 billion. So they're basically a dividend play, and you're going to get some growth. So in the last 10 years, it's up 110%. So that's about 7.5% a year. You add in a 2.5%, 3% dividend, 10 or 11% return. Warren Buffett famously started buying Coke in 1987 at a 30 PE, because he said, listen, this is a great company. And I think he's made about 11.5% return with dividends since then for paying a 30 PE. His idea was, this is a moat. This is the moat of all moats. So pretty interesting. But it is selling for 25 times earnings and 27 times free cash flow. Feels a little expensive maybe, but again, if you're on the Warren Buffett train of this one, maybe you're okay with that. Let's look at analyst estimates for earnings per share. Not much growth here. 4.3, 7, 6, 11, 6. Not much growth, but probably a very safe earnings per share. And revenue growth, about inflation, 3 to 5%. All right. So let's go to the stock analyzer tool and see what's going on with Coco Kizzle. Whoops. I hit the button. So revenue growth, I did 3, 5, and 7%. I would actually understand doing 3, 4, and 6. 3, 4, and 5. I'm actually going to do that. 3, 4.5, and 6. Let's do that. Margin 20. Let's do 20, 22, and 24. Same with free cash flow. It might be a little low. And for PE, 20, 23, and 26. Let's do that. And then I'm going to do 9% across the board. Hit the analyze button. All right. It's pretty close. 38 in the low side, 70 in the high side, 52 in the middle, and it's 62. Now remember, these returns include the dividends, so don't get excited thinking you have to add dividends to this. So guys, even though it's a great company, I don't know, for me, I think there are better opportunities out there. Frankly, I think PayPal is a better opportunity if you want growth. That's my opinion. Now guys, remember with PayPal, this is the thing I always preach about. I preach about this. When the stock was going up, the news was great, but the stock was unreasonably priced. Stock's going down, news is awful. Now here's the deal. The all-time high was 2021, and that's July of 2021. Let's see what they were doing back then. Let's pull up quarterly results. In July of 2021, the September, they did 6.18 billion in revenue. That was that quarter, okay, when it finished, and profit of $1 billion. They're now doing 8 billion in revenue and profit of $1.4 billion. So my whole point about this is, the profit's not that much higher. It's about 35% higher, but the stock is down. How much? 80%? That's what I mean when I sit there and say, when news turns, companies can turn very fast. And if you loved PayPal at this price, what the hell are you doing right here? You better be buying a crap load of it. Because you have to sit there and say, if you thought that this fundamentals look great here, how do the fundamentals look good here? How do they not look good? And then what's our goal? Our goal is to sit there and say, okay, Where's price? Where's value? When there's a disconnect, when value is above price, you should be buying, or at least taking a deeper look into it. That's the whole thesis we have in this channel. We're going to use the fundamentals to sit there and say, what's a long-term play? Now, what happens in the short run? I have no idea. I have no idea. And guys, I love our followers. And I get emails and messages on Twitter and Instagram all the time saying, Paul, I bought this company after I learned your process. It did great. I'm like, yeah, it's short run though. What about the long run? That's what really matters. This company could go, PayPal, I have no idea where it's going to go in the next year. It could go to 30. It could go to 20. It could go to 0. I have no idea. But the point is, if you apply this process to 20 or 30 or 40 stocks, whatever you choose, you're going to do well. If you really, but here's the key, how you do well. It's the emotional part. That's what's so important. Great investors always say that they're going to make their money holding and riding it out. And in order to ride it out, you got to go through ups and downs. Berkshire Hathaway 3 or 4 times since the early 70s has fallen over 50%. And Warren Buffett and Charlie Munger have always said, yeah, but I didn't feel any poorer. That's what makes investing hard. And that's what makes it so awesome that we have YouTube. You can sit there and be around like-minded people. You can sit there and learn from these people. We have our community here for exactly that reason. Thousands of people in that community talking every single day, helping each other make better investment decisions, but more importantly, make better emotional decisions to calm ourselves down. Because it's so easy to get bogged down by this news out there. If PayPal had missed here, what would have happened? I don't know. If they'd missed on both revenue and profit, I have no idea. But is it amazing they missed on profit and they're still up? But that's what makes investing hard, and that's why I created the community in this software. Make good fundamental decisions, but 90% of successful investing is the emotional part. And that's what this community solves. So guys, if you're interested, click the link below. We have a wait list now. We only have X amount of spots per day available. So go sign up now, because once those spots are sold for the day, you got to be put on a wait list. And I don't know how long it's going to take. So click the link below, $7 for 7 days. You may as well sign up because it's such an easy sign up for $7 and you avoid that wait list. So stock number 3, let's check out McDonald's. Now guys, not going to lie to you. I go to McDonald's every morning. I get a sausage burrito and I get a large Diet Coke light ice. Yeah, I love it. It's the best. It's absolutely the best to me. And I get that sausage burrito and I eat it. And I'm like, oh, this is so good. And that Diet Coke from McDonald's is better than their Coke Zero, by the way. So I stick with that. The stock's down now $2, about 0.73%. Guys, seems a little pricey, but again, it's McDonald's. 27 times free cash flow, 23 times earnings. Now, their net income, 5-year net income and 5-year free cash flow are pretty similar, a little bit different, not a ton, about 10% within each other. Net income of $8.5 billion last year, free cash flow 7.25, and again, a big dividend payer. 2.3% eats up $4.5 billion of their free cash flow. So they're taking all their cash flow, majority of their cash flow, and paying it out in dividends, which is fine. But remember, it is double taxed. This free cash flow is after their tax, and when they pay the dividend to you, you got to pay another tax on top of that. So write to your Congress people, put an end to that. But guys, McDonald's is not a grower. 10-year revenue growth is actually down. 5-year is 4.5%. 3 years, 1%. It is not a growth company. It's a solid, stable company. So because of that, I think you got to get a cheaper price on it, but it is quite the moat. So what's that cheapness mean to you? I don't know. Let's see what the analyst estimates are on McDonald's. Oh, wow. Pretty decent growth here. EPS of $12.65 growing to $20. That's high single digits, low double digits growth for EPS. Okay, maybe it is a grower. Revenue growth, 4, 5, 6%. Okay, pretty standard stuff. Let's go to that stock analyzer tool. Let's go to MCD. When was the last time I did that? January 17th of this year. Okay. So I did 2, 3.5, and 5% revenue growth. So a little bit lighter than the analysts are giving us. Profit margin, I did 22, 25, and 28. Now here's why I went 25 here. 10-year number was 24.8%. 5 years, 29. 1 year is 33. So the question you have to ask yourself, is it going to be closer to the last 5 years or the last 10 years? Well, let's go a little bit more aggressive with it just to see what we think it's worth. Let's do 24, 27.5, and 31. And free cash flow, as you can tell right here, guys, the free cash flow is lower than their profit margin by 3%, 3%, 5% almost. So I'm going to do 21, 24.5, and 28. It's fine by me. PE. I did 17, 20, and 23, and price of free cash flow 17, 20, and 23. Guys, another reason to join the community, you can put your own numbers in here because this is what makes investing hard. It's an art. This is part of the art here. These are my P's. If you sat there and said to me, Paul, I'm putting 20, 23, and 26, I wouldn't say, you're crazy. I'd be like, okay. I get that. It's all about how you put the numbers in, how comfortable you feel with the investment. That's not something I can force onto you. I don't want to. I want you to independently get the knowledge and use the community to have the conversation of the appropriate multiples to put in. And I love it when people share their stock analyzer with me in the community. And I go, oh, I think you're high on the PE, but I think you're low on this PE. It's all these back and forths. And again, 9% desired return, no margin of safety, but we need margin of safety because investing is an art. Valuation is an art. The future is unknown and we're human. We make mistakes. So you need that margin of safety. Hit the analyze button. Guys, it just seems a little frothy. 110 to 130 on the low side, 230 to 250 on the high, 160 to 180 in the middle. It just seems a little rich to me. Just a little rich. I have in my watch list at 150. I'm probably going to change that to 175 so I can start selling puts at lower prices. So again, I'm not buying it at 175. I'm just selling puts. Fourth and final company, guys, 3M. Another company that I own. They are having a killer day, up 5% today to $97 after their spinoff, by the way. Company all-time high of 217 back in 2018, January 26th. It has been 6 years since I've seen the all-time high. 6 years. Okay. Free cash flow, $5 billion. Look at this net income, negative $7 billion. That's their settlements of those lawsuits, all these charges. So as you can tell, the net income and free cash flow are very different. Free cash flow is better. It's a $52 billion company with $5 billion in free cash flow. That's 10.4 price to free cash flow. That's pretty incredible. That is pretty incredible. Okay, let's see what analysts are saying here. Analysts are saying, all right, reasonable growth, nothing major. EPS growth, 4, 5, 6, 7%. Nothing to write home about. And guys, revenue growth, I expected this. 1%, 3%, 3%. Somebody went in here huge, 15% revenue growth. I think this is going to be a nominal GDP growth kind of company for revenue. Why? Because it's the all-around company. They make stickers. They do all these things. Now, guys, quick reminder, subscribe to the channel if you like these recaps as a quick way to get an idea about what's going on in the companies. So again, let's go to our stock analyzer tool. Let's pull up 3M. Last time I did it, I did 1, 3, and 5% revenue growth. I did 10, 12.5, and 15% profit margin. Free cash flow, I did 12, 14, 16. Look at these free cash flow numbers versus net income. Okay, PE, I did 15, 17, and 19. And price of free cash flow, I did 15, 17, and 19. And again, 9% desired annual return. Hit the analyze button. All right, low price of 80 to 90, high price of 180 to 200, middle price of 120 to 136. Guys, tomorrow morning on the main channel, we have AMD, Amazon, and Starbucks reaction. Make sure you go check that out. Thank you very much for your time.